Alright everybody, let's have a talk. It's a topic that makes many of you squirm, I know it does. We're talking about long-term care. It's not glamorous, it's not exciting. But let me tell you something. Ignoring it is one of the biggest financial mistakes you can possibly make. You work so hard your entire life to build a beautiful nest egg. You save, you invest, you do all the right things. Then a health crisis hits. And in the blink of an eye, that nest egg you spent decades building can be wiped out. Gone. This is not a maybe. This is a reality for millions of people. You cannot afford to be financially unprepared for this. Let's get down to the numbers because numbers don't lie. The U.S. Department of Health and Human Services says that someone turning 65 today has almost a 70% chance of needing some type of long-term care services in their remaining years. Do you hear me? 70%. That is not a small number you can just wish away. And the cost? Oh, you better sit down for this. In 2025, the national median cost for a private room in a nursing home is over $115,000 per year. Assisted living isn't much cheaper. Even having a home health aide come to your house can cost tens of thousands of dollars annually. Do you have that kind of money just lying around? Now, many of you are thinking, Suze, Medicare will cover it. Stop right there. That is a myth, a dangerous one. Medicare will only cover a very limited amount of skilled nursing care for a short period, typically after a qualifying hospital stay. It is not designed for the long-term custodial care that most people need, help with bathing, dressing, and eating. Medicaid might cover it, but to qualify, you have to be nearly destitute. You have to spend down almost all of your assets. Is that really how you want to end up after a lifetime of hard work? Giving up everything you own just to get the care you need? That is not a plan. That is a catastrophe. So, what are you to do? This is where planning comes in, especially for those of you in your 40s, 50s, and 60s. This is your prime time to get this figured out. The longer you wait, the more expensive your options become. Or worse, you could develop a health condition that makes you uninsurable. You cannot stick your head in the sand and hope for the best. Hope is not a financial strategy. You need to look this possibility straight in the eye and make a powerful, intelligent decision about how you are going to protect yourself, your spouse, and your family from financial ruin. You owe it to yourself. You owe it to them. So, let's talk about the most well-known option, traditional long-term care insurance, or LTCI. This is a standalone policy. You pay a premium, usually every year, and in return, the insurance company promises to pay for your qualified long-term care expenses up to a certain daily or monthly limit. Think of it like car insurance. You pay for it hoping you never have to use it, but you have it just in case disaster strikes. The main advantage here is that it provides dedicated, significant coverage for care costs. It protects your retirement savings and assets from being drained by a long-term care event, which is exactly what we want. However, there are major downsides to traditional LTCI that you must understand. The biggest one is the premiums. They are not guaranteed. Insurance companies have a history of dramatically increasing premiums on these policies over the years, sometimes by 50% or more. This leaves many policyholders in a terrible position in their 70s or 80s when they are on a fixed income and can no longer afford the payments. They are then forced to drop the policy, losing all the money they paid into it for years. That is a risk you absolutely cannot ignore. It is a very serious problem with this type of product. Another major issue is the use it or lose it nature of these policies. If you pay premiums for 20 or 30 years and are fortunate enough to never need long-term care, that money is gone. There is no cash value. There is no death benefit for your heirs. The insurance company simply keeps all the premiums you paid. This is a tough pill for many people to swallow. They feel like they are betting against their own good health, and if they win that bet by staying healthy, they lose all the money they invested in the policy. It feels like a gamble, and for many, it's a gamble they're not willing to take. Because of these significant drawbacks, the rising premiums and the use it or lose it structure, I am generally not a fan of traditional LTCI policies anymore. Can they be right for some people in some very specific situations? Yes, but you must go into it with your eyes wide open. You need to make sure the insurance company is highly rated and has a stable history. You need to understand the policy inside and out, the elimination period, the benefit period, and the inflation protection. But for most people listening to me right now, there are better, more modern options available that address these fundamental flaws. This brings me to what I believe is a much smarter solution for many of you: hybrid long-term care policies. These are the new kids on the block, and they solve the biggest problems of traditional plans. A hybrid policy combines two types of insurance into one product. Most commonly, it's a life insurance policy, or an annuity that has a long-term care rider or benefit attached to it. This combination gives you far more flexibility and gets rid of that terrible use it or lose it feeling. You are no longer just buying insurance for a single specific risk. You are getting a multi-purpose financial tool that can help you in several ways. Here is how it typically works. You fund the policy, often with a single lump sum premium or payments over a few years. If you need long-term care, you can access a pool of money from the policy to pay for it, often a multiple of your death benefit. For example, a policy with a $150,000 death benefit might provide $450,000 or more for long-term care expenses. This provides the protection you need. But here is the beautiful part. If you never need long-term care, your heirs receive a tax-free death benefit when you pass away. So, the money is never lost. It either pays for your care or it goes to your loved ones. The advantages here are powerful. First, the premiums are often guaranteed. You know exactly what you will pay, and the insurance company cannot come back later and demand more money. This provides incredible peace of mind. Second, you get your money's worth one way or another. The benefit will be paid out for care, as a death benefit, or in some cases, you can even surrender the policy and get most or all of your original premium back. This eliminates the risk of paying for something you never use. It turns a potential waste of money into a guaranteed asset for you or your family. This is why I tell so many people in their 50s and 60s to look into these hybrid options. They are a far more efficient and secure way to plan for this risk. You are taking an asset you might already have, like money sitting in a low-interest savings account or CD, and repositioning it to do so much more for you. It provides leverage. It provides security. It provides a legacy. It is a solution that addresses multiple financial goals at once. You must, however, work with a qualified financial advisor to find the right policy for your specific situation, as they can be complex. But they are absolutely a tool you must consider. Now, there is another path some of you might be considering: self-funding. This means you don't buy any insurance at all. Instead, you plan to pay for any potential long-term care costs out of your own pocket, using your savings and investments. For this to even be a remote possibility, you need to be a very wealthy individual. And I don't mean you have $1 million in your 401k. I mean you have at least $5 to $10 million or more in investable assets. The reward, of course, is that you don't pay any insurance premiums. You keep your money under your own control, and if you never need care, you haven't spent a dime on it. However, the risks of self-funding are massive, even for the wealthy. A prolonged need for care, especially for a couple, can decimate even a multi-million-dollar portfolio faster than you can imagine. What if both you and your spouse need care at a specialized memory care facility for 5 years or more? You could be looking at a bill of over $2 million. That's money that is no longer growing for you, no longer providing an income, and no longer there to pass on to your children. You are essentially trading a predictable, fixed insurance premium for an unpredictable, uncapped, and potentially catastrophic expense. It is a huge gamble on your future health. Furthermore, there is an emotional cost to self-funding that many people overlook. When you are paying for care out of your own savings, every check you write feels painful. You watch your life savings dwindle month after month. This can create immense stress and guilt. People may even opt for cheaper, lower quality care to try to preserve their assets, which is the last thing you want when you are vulnerable. Insurance, on the other hand, shifts that financial burden and emotional toll to the insurance company. The checks come from them, not from your retirement account, allowing you to focus on your health, not your bills. So, I have to ask you, are you approved or denied for self-funding? For 99% of you, the answer must be a resounding denied. It is simply too risky. The smart money does not self-insure for a risk this large and this probable. The smart money leverages the power of insurance to protect assets. The time to make this decision is now, while you are healthy and have options. Do not wait until it's too late. Please, talk to a qualified, vetted financial advisor. Explore traditional LTCI, investigate hybrid policies, and understand the true cost of self-funding. Make a plan today to protect your tomorrow. You you are too smart and have worked too hard to do anything less.